back with us for his Fed tradition. It's good to have you.
Great to be here, Sarah.
Lot to unpack here. What did the Fed chair just say to you?
So I think we got a little bit of everything from the Fed chair. You know, he came out and he talked about the full effects have not yet been felt. So again, that was a little bit of what we heard last.
The lags.
The lags, the cumulative effects. So we got the cumulative effects statement. And then he talked about the dot plot. And the dot plot, I think, was the one surprising fact that we got here. You know, where you just mentioned 17 out of 19 over 5%, about 5.10. But I remind you, that's 60 basis points away from the 4.5%, which is the top of the range where we're at now. That's one increase at 75 basis points. So we're not that far away. We're with 60 basis points over the top end of the range right now. So we're in striking distance. And then during the conversation, he got asked a couple questions about the restrictive rate. Are we restrictive? He said we are getting into restrictive territory.
Yep.
And that allows me to slow down potentially. Paul talked about potentially 25 basis points in February being on the table, which would make sense. If you're 60 basis points away from your terminal rate, and your terminal rate's sometime in the middle of next year, you know, 25 basis points would clearly be on the table.
So is that your expectation out of this for February, which is the next meeting?
I think today, as I sit here, that would be my expectation. You'd sort of have February and March.
He definitely seemed open to 25 basis points, which is a step down from the 50 we got today.
If you do 25 in February and March, you're at 5%.
Right.
You're basically at your dot plots by the end of Q1 of next year.
But he talked a lot about how, while it was welcome, he used the word welcome to see the inflation rate come down, which we saw in the past 2 months. He mentioned services inflation, which does remain high and climbing. He mentioned wages, which also remain high. And he said the labor market continues to be extremely tight. Why is this a problem for the Fed?
Well, Sarah, I'll point something out here. This cycle started last March. It started 10 months ago. So that's what would be interesting if we get to the end of the first quarter next year. We'd gone a one-year trip. When we started 10 months ago, you and I were sitting here talking about the price of lumber.
Right.
We were talking about the price of gasoline. We were talking about the price of oil. We were talking about the price of shipping containers.
Right.
And
Turns out that was all transitory.
That was what was driving inflation. All of that is gone. In fact, I think oil hit a 52-week low last week. The commodity markets, or the input side of the equation, is basically unchanged year over year at this point. Now, look, we're not feeling that yet in the stores, and we're not feeling that as consumers yet because there's a lag that has to work its way through. But at the spot market today, we're basically back to unchanged input prices.
And there's an increase, and there's evidence that rents are starting to roll over, even though it wasn't in the CPI chart. He mentioned as such,
right.
But he's worried about the historical record suggesting premature loosening of policy while inflation is still high.
So that leaves you with wage inflation. So everything we're seeing is wage driven. I even think that's what you're seeing in the grocery store. If the commodity prices are unchanged, but you're seeing much higher groceries, it's because of all of the wages that are involved in getting those groceries to the store, all of the warehousing, all of the truck drivers, the people in the grocery stores, they're all getting paid more money. So we really have to look at the wage component of the situation. And so we're in this sort of vicious circle, and I think we're at the end of this cycle right now. We're in this cycle where in the pandemic, the government initially paid people not to work. The government gave you money to stay home.
That was under the Trump administration.
It was also under the Biden administration. I'll remind you it was under both administrations. I think you have to be honest and say it was under both administrations. There was a large stimulus package under both. And the government has continued to give you relief, whether it's student loan payment relief or enhanced child care credits. The government has continued to give people stimulus. A lot of that stimulus was pent-up demand. Initially, it was pent-up demand for goods. Then it became wildly pent-up demand for services. And services, people wanted to go travel. They wanted to go see their family. They wanted to go on vacation. They wanted to go out to dinner. They wanted to have a good time. We are starting to see some of that disposable income coming out of the system. We're now starting to see credit build in people's account. We're starting to see default rates build. So we're starting to see a much more normalization. I think we're in this 3-year normalization cycle. If people are getting back to normal, it means they're going to have to go back to work. They can't just go spend money and have a good time. They're going to have to go back to work. If they come back to work and we re-normalize this cycle, that will help us with the wage side of inflation. So I do think we're at this interesting point of inflection here as we get into next year.